Goodwin's strategic review is not yet a sale, but it changes the question investors should ask. The market reacted as though value might be unlocked, with the shares rising about 13% to 21,250 pence on 7 August. Yet the assets being considered for disposal include businesses that have benefited from stronger defense spending. Whether this creates value, therefore, depends on what Goodwin would be left owning, not simply on the existence of a buyer. The review covers a substantial part of the mechanical engineering division, including Goodwin Steel Castings, Goodwin International, Noriva, ESAT, and Pumps. The company says it is considering several options to maximize shareholder value while maintaining customer continuity and the long-term prosperity of its businesses. Rothschild & Co. is advising, but discussions remain ongoing, and Goodwin has stressed that there is no certainty that a transaction will take place. That uncertainty matters because these are not peripheral operations. Goodwin's mechanical businesses supply components to UK and US frigate and submarine programs, including the Dreadnought nuclear deterrent program and the Type 26 frigate program. Its latest annual report, as described in the coverage, said Goodwin Steel Castings and Goodwin International had delivered a particular boost to profits as economies increased defense spending.
That was the established reading of the company, a family-controlled engineering group whose specialist businesses were benefiting from defense and energy demand, supported by stronger order books. The company's shares had already risen sharply from below 5,000 pence 3 years ago. The review unsettles that straightforward growth story because the businesses attracting strategic interest may also be the businesses carrying much of the recent earnings momentum. The direct mechanism is therefore a change in ownership and business mix. If a substantial part of mechanical engineering were sold, Goodwin could receive a cash inflow or crystallize a valuation for assets the market may have treated as embedded within the group. But the group would also surrender some future revenue, profit, and defense exposure. The available evidence does not quantify the division's share of earnings, so it cannot establish whether the sale would strengthen the remaining company or remove its most valuable engine.
There is a second reading. The review may represent portfolio management rather than a retreat from defense. Goodwin would retain its refractory engineering activities, and the company has framed the process around continuity rather than withdrawal. Reports also say several potential buyers with defense experience have shown interest, which suggests the assets may be strategically valuable. But that remains reported interest, not a binding offer, and no price, buyer, timing, or final asset parameter has been disclosed. The timing also limits the easy bullish interpretation. One report recalled that Goodwin suffered a setback in March after losing 2 significant contracts and facing order delays in the Middle East. That means the review could be a response to changing commercial priorities, as well as an attempt to monetize strong defense demand. The articles do not establish which consideration is decisive. For a holder, the important change is that Goodwin can no longer be assessed only as a continuing defense-linked compounder. The outcome of the review could alter the balance between immediate value realization and future operating exposure. For a watcher, the share price reaction has already recognized the possibility of value being released, while the evidence still leaves open whether the remaining group would be more profitable, less exposed to growth, or simply different.
The strongest current judgment is that Goodwin's defense businesses appear valuable enough to attract strategic interest, but the review does not yet prove that selling them would improve shareholder returns. The next meaningful checkpoint is the company's promised update on progress, especially whether it identifies a buyer, a price, and the exact businesses to be transferred. Until then, the material uncertainty is not whether Goodwin has valuable assets, but how much of that value would remain inside Goodwin.